Don't let the age 59.5 rule keep you from an early retirement. At its most basic level, the rule says that if you withdraw money from an IRA prior to age 59.5, you will not only owe any taxes due, but also face a 10% penalty. However, this rule should never prevent someone who is otherwise able to retire prior to age 59.5 from actually doing so, for a number of reasons. Number one, you can withdraw from Taxable First. Anyone who saved enough money to be able to retire before age 59.5 probably was not able to fit all of their savings into their available retirement accounts. They likely also have a sizable taxable account from which money can be withdrawn without any penalty, simply by paying any long-term capital gains taxes that are due. Those taxes, of course, only apply to the gains. The principal comes out tax-free. Generally, the earlier you retire, the larger the ratio of your taxable accounts to your retirement accounts will be. So you can simply live off the taxable assets until you turn 59.5 and then tap into the retirement accounts. Spending taxable assets first is generally the best move anyway, as it allows your retirement accounts to continue to benefit from the tax and asset protection offered by retirement accounts for a longer period of time. Number two is 457Bs, 401Ks, and 403Bs. Many types of retirement accounts are not subject to the age 59.5 rule. For example, many doctors are eligible for a 457B account, a type of deferred compensation. While the distribution rules in every 457B are different, you can often access this money penalty-free as soon as you stop working. 401Ks and 403Bs have an age 55 rule, where you can withdraw from them penalty-free once you are 55 and stopped working. If you plan to do this, be sure not to roll your 401k into an IRA as soon as you separate from the employer. Number three, HSAs, health savings accounts. Withdrawals from HSAs to pay for healthcare are also not subject to the age 59.5 rule. Those withdrawals come out tax and penalty free at any age. While an HSA generally cannot be used to pay for health insurance premiums, it can be used to pay premiums for COBRA. It can also be used to pay Medicare premiums when you get to that age. After age 65, all withdrawals from an HSA are penalty free, although only tax free when used for healthcare. Number four, Roth IRAs. Roth IRA contributions can always be withdrawn tax and penalty free. Only the earnings are subject to the 10% penalty. Note that if you have funded your Roth IRA via Roth conversion, such as through the back door, that principal is subject to a 5-year waiting period before it can be withdrawn tax and penalty free. If Roth IRA principal withdrawals are your plan to cover living expenses between ages 55 and 60, then you need to make sure you've started doing any necessary Roth conversions by age 50. Number five, the SEPP Rule. Consider the substantially equal periodic payment rule. This allows you to start withdrawing from retirement accounts at any age, penalty-free. Once you start SEPP withdrawals, you must continue them for at least 5 years or until age 59.5, whichever time is longer. The amount you can withdraw is limited, but is approximately equal to the amount you should be withdrawing anyway if you want your money to last for a long period of retirement. There are 3 different methods you can use to calculate these withdrawals, but all of them would allow a 50-year-old to withdraw 3 to 4% of the portfolio per year penalty-free, and a 55-year-old to withdraw 3 to 4.5% penalty-free. Number 6, other exceptions. There are many exceptions to the age 59.5 IRA withdrawal rule. These include paying for medical insurance, disability, qualified higher education expenses for you or your children, a first home for you or your children with a $10,000 limit, a new child or adoption, a $5,000 limit, an IRS levy, and a military reservist distribution if on active duty. Number 7, an IRA. Finally, IRA money is never locked up. It is your money, and you can access and spend it anytime you like. The age 59.5 rule only applies a 10% penalty to otherwise unqualified withdrawals. Few early retirees ever have to pay that penalty, but it is always an option to just pay it. Congratulations on saving up enough money to retire early. Knowledge of IRS rules and careful management of withdrawals should allow you to cover your expenses without ever paying the 10% early withdrawal penalty on IRAs.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.